Hi everyone, my name is Speziale, and I'm the national best-selling author of Market Masters. Today, I'll be sharing with you how this hedge fund manager achieves a 24% compound annual return. There's a couple of investors I have in mind for the potential sequel to my book, Market Masters. I already mentioned Francois Rochon in a past newsletter, which you can subscribe to on my website, robinspeziale.com. Francois Rochon's firm, Giverny Capital, has posted a 16.3% compound annual return since inception. Another investor I would like to interview is Andrew Brenton of Turtle Creek Asset Management. He'll be the focus of the video today. Since Turtle Creek was founded by Andrew Brenton on November 1st, 1998, an investment of $1,000 has grown to over $49,000, which equals a compound annual return of 24.1%. That demonstrates a remarkable wealth building ability. Turtle Creek is long only, comprised of North American equities, primarily Canadian, and they only hold around 25 holdings at any given time, with average market caps of $7 billion per company. While I haven't sat down with Andrew yet to document his investment strategy in detail, I've conducted some preliminary research. And so what I've posted for you in my newsletter and what I'll explain here in the video is Andrew Brenton's approach to identifying the companies they want to own and their common characteristics, the source of which is from his 2015 letter to shareholders. Andrew Brenton says, "The universe of companies from which to choose is quite large. There are approximately 2,400 companies listed on North American stock exchanges with market capitalizations of between $1 billion and $25 billion. So how do we sort through them to identify the ones that deserve our attention? The first common characteristic is that our companies are cash flow positive. And the second related characteristic is that they typically have strong balance sheets. Essentially, none of our companies need us. They don't need the public markets to pursue their business strategy. That doesn't mean they never access the capital markets by selling treasury shares. Many of them have issued equity over the years, but they generally don't need to and tend to do so only at attractive prices. Great businesses typically generate more free cash flow than they can profitably reinvest, and therefore don't need to raise additional equity capital. More importantly, they don't need to raise equity capital at times when prices would be dilutive to shareholder value. Our companies we own are good at allocating capital, including the substantial cash flow that they generate. In addition to deploying their cash internally on high return opportunities, many of our companies deploy capital externally on acquisitions. This is the third common characteristic. Currently, over 2/3 of the portfolio by value is comprised of companies where growth through acquisitions is an important part of their strategy. Our background and experience allow us to select good acquirers, avoiding the multitude of companies that destroy shareholder value with acquisitions. Our companies have a variety of approaches to creating value through acquisitions, but are all capable and disciplined buyers that are not willing to overpay. Our companies would rather sit on the sidelines when prices are too high. A fourth common characteristic is returning capital to shareholders, either via dividends or repurchasing their own shares. But in the case of share buybacks, the purpose is not interesting EPS accretion, as one CEO put it. Our companies decide whether or not to repurchase their stock with the same hard-nosed evaluation to which they subject potential acquisitions. Good allocators of capital understand when their shares are cheap, just as they understand when an acquisition is well priced. The fifth and final characteristic is that our companies have big, rational ambitions. While most of our companies have global ambitions, some are content to operate only within Canada or the US. That's why the modifier rational is important. It's not enough to own companies that have big growth plans. Growth for its own sake can be a recipe for disaster. It's important to own companies that press their advantage when it serves and knows when to pull back in the face of a poor environment or irrational competitors. To summarize, the 5 characteristics that Andrew Brenton of Turtle Creek Asset Management looks for in a company he invests in are: 1. They must be cash flow positive. 2. They must have strong balance sheets. 3. They must deploy capital externally on acquisitions in a smart way. 4. They return capital to shareholders, either through dividends or repurchasing their own shares. And 5. They have big but rational ambitions. OpenText Corporation is a core holding in Turtle Creek's fund. I encourage you to read Andrew Brenton's additional newsletters on his website, Turtle Creek Asset Management. He has many great case study frameworks that you can apply to your own stock selection process. Thanks for watching. Please subscribe to my channel for new videos. Visit my blog on robinspeziale.com and buy my book, Market Masters. All links are in the description to this video. Happy investing, everyone.